So, welcome everyone to this amazing revision session of Index 28, where we are going to revise the concepts along with the questions. If you are watching this on YouTube, you can download the board notes from my Telegram channel. If you have enrolled for the session, very good. If you have not enrolled, or if you want to recommend your friends, my lectures are available on bbwatchers.com. Anyways, chalo. So let's start the revision of Index 28 in 3, 2, 1 and go. First of all, Index 28, investment in associates and joint ventures. Okay. So what is the meaning of associates? Whenever you have a stake between 20 to 50%, that gives you significant influence. Okay. And if you have significant influence, then it is your associate. Of course, in associate, we don't have control or joint control. If you add control, you go in subsidiary. If you have joint control, let's say you are 4 parties holding 25% each, and there's joint control, then you will go in Indus 111 joint arrangements. Okay. So I'm assuming here you don't have any joint control. You have this much stake. So influence, associate. Also, we are discussing about joint venture. Remember, the definition of joint venture is covered in 111, but the accounting is covered in Index 28. So the concept which I discussed for associate, the same accounting logic is applicable for joint venture also. Okay, chalo. So now let's say, for example, I am the parent and I have some 35% stake in BB Limited. So I become the parent, BB Limited becomes the associate for me. So this parent will prepare two financials. One is SFS as per Index 27, one is CFS as per Index 28. In SFS, they show the investment at cost or fair value under equity method, or in case of associate. In CFS also we show investment only. Sir, if you are showing investment in both the financials, what is the use of preparing two different financials? In SFS, we show the investment at cost or fair value. But in CFS, we show the investment as per equity method. Now, what is equity method? It is nothing but a measurement technique. At which value you will show the investment in CFS, that is equity method. So it is a measurement technique to measure an investment. Okay. So the difference in SFS and CFS is that the line item is the same. The amount will be different. Amount in SFS is different, amount in CFS will be different. Okay. Then to elaborate what is equity method, we took one example. Okay. So where AK had 20% stake in Muku, it was acquired for 100 lakhs. Okay. Then INS book value was 200 lakhs, fair value was 250 lakhs. Okay. Difference was due to a PP which was valued at fair value and has a remaining life of 5 years. Okay. During the year, Muku earned a profit. During the year, Muku earned a profit of OCI also. Muku distributed dividend, and also there is some URP. 10 lakh goods sold for 15 lakhs. What to do in associate? So first, in case of associate, you will first compute goodwill or GBP. That is the first step. How will you compute it? So PC, you have paid for 25%. So write whatever you paid. Take the INA also for 25%. Yeah, there is no concept of NCI. Okay. PC 25%. Take the fair value of INA 25%. You will get the goodwill. Because you don't have control here, goodwill is only disclosed. But if you get GBP you can recognize through this entry. Okay. But if there is goodwill, just disclose it. Don't do anything. Okay. Chalo. Now what is equity method? So on first day, you will record the investment at cost. In bracket, because we want to disclose goodwill, I will disclose the goodwill. Okay. Then, because we acquired the INA at fair value, the INA worth 200 were acquired for 250. So the gain amount was 50. And if there is a gain on depreciable asset, there will come excess depreciation. So life is given for that only. So gain amount was 50. On that, you will calculate excess depreciation for 1 year. So you will say 50 into 1 year divided by total life is 5 years. You will get 10 rupees. So you will deduct the excess depreciation, but not full 10. Because here there is associate, your stake is 25%. You will do everything up to your stake only. So you will do 10 into 25% basically. Okay, so here this is what will happen here. Excess debt 50 into 1 by 5 into 25%. You will get 2.5 lakhs. Eliminate this. Okay, the next adjustment was Muku, associate earned a profit. If associate earned a profit, I will increase the value of investment up to my share of profit. So my share is 25%. Increase it. Entry I also have given. Okay, similarly, associate earned one more profit, but that profit was in OCI. So I will also record that share of profit. The difference is when I pass the entry in CFS, the PNL profit, the entry is investment to consolidated PNL. The OCI profit entry is investment to console OCI. Simple. Okay. Chalo. Then this Muku also distributed dividend. Because of dividend, the value of investment goes down. Not going into the logics. Logics we already discussed in the class. Just remember the value of investment goes down. So my share of dividend, I will reduce the value of investment. Now there was also an intercompany transaction of sale purchase. So there was a URP of 5 lakhs. Okay. So I will eliminate the unrealized profit, but not full 5 lakhs, only up to my share. That is 25%. 5 lakhs into 25%. So remember, in case of associate, we will do everything only up to my stake. Okay, chalo, done. This you get the investment on a year end as per equity method. This is simple. This is what equity method is all about. Now, based on this example, we have done 3 illustrations. Illustration number 10, simple. Okay. Illustration number 18, we will discuss. Okay, because it is important. So instead of discussing 3 same examples, we will discuss one question. Okay. So let's say there was a illustration number 18. Investor is having 35%. Okay. So it is able to exercise significant influence. PC we have paid for 47.5. Okay. And the INA's fair value was 1.1 CR. So first find the goodwill. How will you find the goodwill? You will take PC 35%, 47.5, INA 35%, 1.1 CR into 35%. You will get goodwill 9 lakhs. Goodwill, if it is goodwill, only disclose. If it was GBB, we would have recorded it. But if it is goodwill, just disclose it. Okay. Now, what else is there? PP, book value was 90. Fair value is 110. So gain amount is 20 lakhs. On that, useful life is given, so excess debt will come. So 20 into 1 by 10 into only our stake, reduce it. Then associate earned a profit of 8 lakhs. Record your share of profit. 8 lakhs into 35%. Okay. Associate earned a profit of OCI also 2 lakhs. So record your share of profit. 2 lakhs into 35%. Associate distributed a dividend of 12 lakhs. Okay, so reduce it. So 12 into your share, reduce it. Simple. So we add the share of profit, we reduce the dividend. Acha, one more thing. If in case associate incurs a loss, so like you add the share of profit, if there was a loss in associate, you will record the loss in associate also. That will be deducted. Simple. So this was equity method, very much simple. If you solve the example given by me, all these small questions are done by default only. Same is question number 3 of mine. Question bank, it is exactly simple, very much simple. Only the important part here is that if associate incurs a loss, you will record the share in loss also. Okay, chalo. So we did these 3 examples, these 3 illustrations. Then we did one more question, that is question number 1. Okay, I discussed also there is an issue with this question. There is an issue in the solution with this question. Okay, so we discussed the correct solution also. What is there? So it says Sumeru holds 35% of Meru. So Sumeru becomes the parent, Meru is the associate. Okay, value of investment is 3 CR. Okay, Sumeru Limited sold goods worth 3.5. Okay, so again there is intercompany, but who is selling to whom? Parent is selling to associate. Okay, chalo, 3.5. So this 3.5 is the selling price. Cost was 3 lakhs. So if you see closely, cost is 3 lakhs, selling price 3.5, profit element is 50,000. Normally we eliminate this, but you have to check whether the inventory was outstanding or not. So it is said out of these goods, costing rupees 1 lakhs to Meru were in closing stock of Meru Limited. So out of this 1 lakh goods were in closing stock. Okay, so you will eliminate the URP only on this 1 lakhs. But this 1 lakhs is in terms of cost or is in terms of selling price. So if you see, they have used the word cost. But this cost is from whose point of view? From Meru's point of view. If you can realize one thing, Meru was the purchaser. Okay, so cost of Meru is the selling price of this transaction. When I say that Sumeru sold goods to Meru for 3.5 lakhs. So 3.5 lakhs selling price for Sumeru, but it is the purchase price for Meru. And that 1 lakhs cost is given from Meru's point of view. So that 1 lakhs is the selling price of the goods. Okay, accordingly you will find the URP on this selling price of 1 lakh goods. So URP total is 14,286. We will not eliminate full. We will only eliminate up to our share. Okay, so 14,286 into 35%. Eliminate this. So record the investment cost. Eliminate the URP. There was some loss also given. So eliminate the loss. Eliminate the loss. We'll get the investment value. The answer as per ICI is 5833 because they have thought that this 1 lakhs is the cost of goods. But that is the cost for Meru na. Cost for Meru is the selling price of goods. So that is why the difference is there. But I feel this is the correct solution. Anyways, chalo. There is a B part as well to this. The only difference here is what if there was a profit in case of loss. So if there was a profit, add the profit. And if there was a dividend, you will less it. Okay, so instead of in the B part, instead of loss, there was a profit and less the dividend. Simple. Okay, sir, simple. So this was the 4 question which we did. Then we did one question, which was upstream and downstream transaction between entity and its associate. Okay, so basically whenever the sale purchase happens, we eliminate the URP. That was the summary of it. But in this illustration, they have discussed in detail how the entries will come. Okay, so remember this was a good question, so do it separately. Okay, I will teach you, don't worry. Equity method. In equity method, we reduce the value of investment to the extent of own share of unrealized profit. I told you one thing, that in equity method, be it upstream, be it downstream, URP gets eliminated from the investment value only. Okay, subject to, of course, that inventory should be outstanding on year end in the group. Now, first scenario number 1, if you see illustration number 13, wait, I will open the illustration number 13. What is given here? It says M has invested 40% in N. Okay, so M has invested 40% in N. So M becomes the parent, N becomes the associate. Okay, chalo. Now they are telling that they have sold goods worth 10 lakhs at a profit of 10%. That is, profit is 1 lakh. Okay, so basically this is sales price. 10 lakhs is the sale price. Okay, so sale price and profit 1 lakh, so cost is 9 lakhs. Okay, who earned the profit? In the first case, N is selling to M, associate is selling to parent. Forget about upstream, downstream. Can I say if associate sells anything to parent, associate earned a profit of 1 lakh? Forget about upstream, downstream. Okay, associate earned a profit. Just remember one thing, whenever associate earns anything, in my investment, I will record the post acquisition share in associate's profit. Okay, so associate earned 1 lakh. As a parent, I will record the share of my share of this profit. So my share is 40%, I guess. So record 40%, 40,000. So first pass an entry for this. Because of this profit share, your investment value increases, and 2 console profit or share of profit. Simple. First this element. Next part is, out of this 10 lakhs, 4 lakh inventory is outstanding. Outstanding inventory is 4 lakhs here. Okay, so we will say that 4 lakhs is outstanding. So out of 10 lakhs, 4 lakhs is outstanding. So how much is the URP now? 40,000. Okay, so this URP will eliminate only up to parent's share. So first find the outstanding inventory, you get the URP on that inventory, then eliminate only parent's share. Parent's share was 16,000. So entry is console PNL to investment in associate, because due to URP or investment reduces. Okay, simple. Scenario A. Scenario B is a little different. When parent sells to associate. So first I visualized everything what must have happened in parent's SFS. So when parents sells a good worth 9 lakhs for 10 lakhs, parent passes a entry something like this. First parent must have recorded COGS to inventory 9 lakhs, 9 lakhs. Then parent must have recorded the sales, receivables to revenue, whatever it is. Okay, now out of this 40% inventory is outstanding. Okay, so now when you are eliminating the URP in this case, you will not pass the entry directly. You will not pass console PNL to investment. No, you will eliminate the revenue and you will eliminate the COGS. Okay, how much I will eliminate? So how much is the outstanding inventory? 40% is the outstanding inventory. I am not saying this, question has mentioned this. 40% out of this 10 lakhs is the outstanding inventory. Okay, so I will eliminate 40%, but in associate we eliminate only up to our share. So I will eliminate the revenue. If I want to eliminate revenue, debit the revenue account. So 10 lakhs revenue into the outstanding inventory percentage 40% into the parent's share of this element. So 10 lakhs into 40 into 40. Similarly, eliminate the COGS. 9 lakhs into 40% the outstanding inventory into parent share 40%. Okay, balancing figure you will get as investment in associate only. So sir, what is the difference between the above two cases? See, in case when there was an upstream transaction, while eliminating URP, we pass a direct entry, console PNL to investment, 1616. But in case number B, when we want to eliminate the URP in downstream, don't pass the entry console PNL to investment. Instead of console PNL, we use the terms revenue and COGS. That is, we are eliminating in gross format. Okay, so revenue debit, COGS credit. So the net effect in console PNL is ultimately 16,000 only. But it is just that we are showing in the gross format. Okay, revenue eliminate this much, COGS eliminate this much, balance is investment in associate. Okay, I have given a summary also. See, this is a question which you need to remember. Okay, so I have given a summary also. In case of upstream, when associate sells to parent, eliminate directly. Okay, 1616. When there is a downstream, eliminate through revenue and COGS. That's it. That is exactly what you need to remember. Simple. Okay, then there was one more question, illustration number 14. So what was there? There was a sale purchase between parent subsidiary of asset in case of 14. Okay, so there is one asset. Okay, so in the first case, I will directly show you the solution only. See, in scenario A, the parent is selling to us into joint venture. A joint venture is there. Be it associate, be it joint venture, accounting is same. When parent sells to joint venture, goods worth 10 lakhs for 8 lakhs. So they are being sold at a loss. What will parent record? Just record the normal sales entry. Okay, asset is going out. Receive the money, debit the profit loss 2 lakhs. Simple, nothing else is there. In scenario A, only this part will be done. This is to be done when an asset is being sold. Don't compare this with the previous part. Okay, we are not talking about URP here. Okay, Scenario B. What if joint venture sold to parent? So if the joint venture sold to parent, then what will happen? Then you will say that the carrying amount was, let's say 10 lakhs, 8 lakhs was selling price. So joint venture must have booked a loss of 2 lakhs. But we want to the accounting in the books of X. For X, it is a purchase. X has purchased at 8 lakhs. The company which is purchasing, on purchase you never book profit or loss. You just record the purchase. So we will record asset to bank. 8 lakhs, 8 lakhs. Enter in the books of X Limited. Simple. One extra entry will come. Because joint venture has booked a loss, whatever joint venture books, I will record my share of it. If joint venture booked a profit, I will record my share of profit. If joint venture booked a loss, I will record my share of loss. Right? So here one extra entry will come. Total loss was 2 lakhs. My share is 50% in this. So I will record my share of loss. Because it is loss, investment value goes down and record the loss. So what is the difference between scenario A and B? In scenario A, the loss was incurred by parent only directly. So parent directly recorded the whole entry. In scenario B, parent was the purchaser. So parent first recorded the purchase. The loss was being booked by joint venture. So whatever joint venture books, I will record my share of it. So I recorded my share of it. Simple. Is this clear to everyone? Okay, sir. So this was your illustration 13-14. Okay. Concept are also there in the notes. But I would suggest rather do the question directly for 13-14. Treat it as a separate question only. Okay. Chalo. Next part. Next concept is discontinuance of equity method. When will you stop following equity method? In two scenarios. Let's say for example, you are parent, you have 30% stake in Mukku. So two scenarios. First, if your stake falls below 20%, that means you dispose the stake and it falls below 20%. Discontinue equity method. There is one more case. If your stake rises above 50%, so let's say you are 30%, you acquire 25% more. So your stake becomes 55%. So basically when the associate becomes subsidiary, you will discontinue equity method. No? Second case. Okay. Next part. Exemption from equity method. Which all companies are exempt from equity method? This exemption point we also covered in IND AS 110 CFS. Okay. But it is very similar. 1-2 extra points are there. Please have a look. 4 examples are there. Please try to understand this. First, let's say there was a company AK Limited. It has a direct stake in Mukku 70% and Mukku has a direct stake in Ajay. So if you try to find AK's indirect stake in Ajay, it comes to 28%. So basically AK has an indirect associate Ajay Limited. So AK will prepare CFS with subsidiary also. AK will prepare CFS with indirect associate also. Simple. But here, who is exempt from equity method? This Mukku. The middle parent. Remember middle parent we discussed in 110 also. The middle parent is exempt. Provided 4 conditions are met. What are the 4 conditions? This company should have a ultimate parent who is preparing. This company should have a ultimate wholly owned or partially owned parent. Basically, this should be a subsidiary of some company. First. Second, it should not be listed. Third, it should not be in the process of listing. And fourth, its ultimate parent is preparing CFS. Okay, so basically if AK is preparing CFS with Ajay indirectly, Mukku is exempt. Second case, if you are an investment entity, let's say you are a mutual fund company, you hold 25% stake in AK Limited. So you are exempt from CF. You are exempt from equity method. Okay. Third example, if AK has an investment in Mukku Limited, assume that Mukku is investment entity. And this investment entity has a stake in Ajay Limited. So can I say my stake is indirectly in Ajay also? How much is my effective stake? 21.6%. Standard says if you have an indirect stake through an investment entity, if you means AK, if AK has an indirect stake through investment entity, AK is also exempt. Okay, so AK is exempt with Ajay from equity method. Why? Because the stake is held through investment entity. The only difference is AK has to measure the investment at FVTPL. Okay. One more extra example. Now this is crucial. What is it? If you have some stake indirectly through investment entity and some stake directly also. Here some different concept is given. Please have a look. So I have some indirect stake through investment entity in Ajay. Okay. So my indirect stake is 12% and my direct stake in Ajay is 15%. Total stake comes to 27%. Now whether AK is exempt or not. So standard says for the indirect stake was 12%. For this much stake you are exempt. But for the direct stake you have to prepare CFS. Now you might say this is a little weird. It is what it is. Okay. So for the indirect stake you are exempt, but for the direct stake you have to prepare CFS. For indirect stake you are exempt only when it is held through investment entity. Do remember this. Okay. And to understand this better, you can also go through question number 2 of my question bank. MTP RTP past exam question number 2. You can go through this. Where is it? This is the question. Wait. This question number 2 of MTP RTP past exam. This question you can go through. Okay. Chalo. So till here we have covered the revision. Okay. Great. So welcome to this, or welcome back to this revision. Okay. We had done till this part where we were discussing about who is exempt from equity method. Okay. Then in this particular part, we will take up 2 questions. So mota moti everything, basically everything is over. But there are 2 more questions. One is illustration number 12. Okay. Now please have a look in illustration number 12. What does it say? It says that there is entity A who holds 20% in B and B holds 100% in C. Okay. So A holds in B, B holds in C. Now forget about A. Now what is B doing? B has 100% stake in C. B is selling 20% stake in C. Okay, so this is a disposal without loss of control. So basically B's stake will reduce, NCI stake will increase. Okay, talking from the point of view of B Limited. So remember we used to pass an entry in Ind AS 110. Cash bank to NCI to consume other equity. The balance is given in the question. How much cash bank, how much NCI is given. Difference is consume other equity. That means the associate booked up profit in consume other equity of rupees 100. Associate booked up profit in consume other equity of rupees 100. As soon as associate books up profit, parent will say, give me my share. Okay. So associate booked a profit of 100, parent records its share of rupees 20. That's it in the value of investment. Okay. So this is how it is interlinked. So now if you want to pass an entry for this, you will say investment in B Limited because the value of investment increases to consolidated other equity. Why? If associate earns a profit in P&L, we also record a profit in P&L. If associate earns a profit in OCI, we also record in OCI. But if associate earns in other equity, we also record in other equity. We means as a parent entity A Limited. Simple. Now just present this in conceptual note format. Okay. That means in a sentence format. That's it. Done. Chalo. Now next part. Loss making associates. Now what is the meaning of loss making associates? New concept. Please have a look here. So let's discuss the relevant part only. Let's say I have 30% investment in Mukku Limited. When I say I have investment, that means I have investment in equity shares. But it is possible in the same associate, I might have investment in preference also, I might have debentures also. Okay. So standard says if your equity investment loss is exceeding, let's say Mukku incurred loss of 400. Now the loss allocated to parent will be 30%, 120 lakhs. My equity is not sufficient to bear the loss. So if our equity is not sufficient, and if you have other investment in the associate, allocate the balance loss in the other investment. Like you had preference. So after equity comes preference. If preference is also not enough, then you will allocate in debentures. Okay. So this logic is applicable only when you have multiple investment in associate. If you did not have this investment, then the maximum loss you will bear is 100 lakhs and the unrecognized loss will stay in your notes to accounts, that is rupees 20 lakhs. Okay. But if you have other investment in the same company, allocate the loss in other investment. So please remember the loss allocation criteria. First, allocate in equity. If not sufficient, then preference will bear the loss. Then debenture will bear the loss. Now on this concept only, we have illustration number 15. What is given? Please have a look here. A very good question for loss making associate. It says we have 3 investments: equity, preference, long-term loan. These are investments for parent. Okay. Balance is given. Now it is said year on year, how much loss is there? So first of all, preference and long-term loan, basically we are allocating the loss of 28, but they are governed under Ind AS 109. So preference and long-term loan will first bear the loss of the respective Ind AS and then they will help Ind AS 28. Okay. And in the last column, one important word is there. Entity share of profit loss in associate. So this loss, normally what we do, associate earns a loss, we multiply by our own share. This loss profit is already our own share of loss. How do you come to know? Entity share word is used. Okay. Now we want to record the closing balance of each year. What will I do? Simple. First at the opening balance, first allocate the loss of Ind AS 109. So in preference, this much was the loss. Long-term loan, this much was the loss. Allocated. So in equity, not applicable as per 109. Okay. So balance not applicable as per 109 means investment in equity shares of associate are governed under 28. Therefore not covered under 109. But investment in preference and long-term loan are covered under Ind AS 109. Okay. So balance after allocating the loss of 109 was this much. Now the loss of 28 was 16 lakhs in the first year. If you see closely, it was 16 lakhs. Is equity sufficient? The answer is no. Equity not sufficient. So first allocate in equity. then allocate in preference, and then allocate in long-term loan. Okay, so write the closing balance. Next year, year 2, everything is 0 except long-term loan is 1 lakhs. Further, in year 2, what is there? There is a loss of 50 in preference. So allocate the loss of 50 in preference. As soon as you allocate the loss of 50 as per 109 in preference, preference becomes negative. But any investment cannot be negative. So what will preference say? Preference will say that in previous year, it helped equity shares up to 4.5 lakhs. From this 4.5 lakhs, it will reverse a loss of 50,000. That means the net help which preference gave to equity was not 4.5, it was 4.5 and 50 is reversed. So net help is only 4 lakhs. We discussed this in class also. Okay, chalo. And what is the share of 28 loss in the current year? 2 lakhs. We don't have sufficient balance to bear the loss. So only long-term loan is there who can bear the loss of 1 lakh. So in second year, we reversed a loss of 50,000 and we borne a loss of 1 lakh. So net loss borne by us was only net 50,000. Out of 2 lakhs, we booked only 50,000. That means how much is the unrecognized loss? 1,50,000. Okay, given a note for the same as well. Chalo. Anyways, next year, year 3. Year 3, in preference, we have a gain. Long-term loan also we have a gain. Book the gain, balance becomes positive. In year 3, there is no share of 28. But you had an unrecognized loss of previous year. Use this positive balance to book the loss of previous year. Book the unrecognized loss of previous year. Simple. In year, so again everything becomes 0. In year 4, there is again a gain in preference share as per 109. Book the gain. Then there is a gain of 28 also. Now, when there is a gain, like a selfish person, don't allocate all the gain to equity. No. Can I say equity were being helped by preference and long-term loan? First, give them the money. Okay. So, who will get the money first? Long-term loan will get the money first. Okay. How much did long-term loan help? So I have prepared a note. In year 1, long-term loan bared my 1.5 lakhs loss. In year 2, bared 1 lakh. In year 3, it bared 50,000. So total loss borne by long-term loan was 3 lakhs. So it was 10 lakhs. I will give first 3 lakhs to long-term loan. Same is the case with preference. Preference borne a loss of 4.5, but it reversed also of 50. So net was 4 lakhs. And then bared another loss of 1 lakh. So total loss was 5 lakhs. I'll give 5 lakhs to preference. If there is any more money left, then equity will get. Okay. In year 5 again, you have a share of 28 profit. Now this whole profit belongs to equity only. Why? Because preference and long-term loan helped us. We already gave them the money in year 4. So in year 5, whatever gain you get, it is only for equity. Okay, so I have given the summary also. Loss borne by equity, preference, long-term loan, sequence. But when you distribute profit, first long-term loan gets. Why first he gets? Because you want long-term loan to bear the loss at the end. So you will have to give him the money first. Okay, so on this note, we complete the revision of IND AS 28 as well. I hope this revision session was helpful. If it was helpful, then do recommend it to your friends as well. Okay, so on that note, thank you so much. Again, just to repeat, if you have watched till the end and if you are watching it on YouTube, do like the session, do leave a comment, and also if you want the board notes, I will upload the same on my Telegram channel. Okay, so see you in the next revision. Thank you so much. Bye bye everyone. Take care. See you all. Bye bye. See you.